while the general public remains focused on retail price charts and daily market noise, a fundamental shift in the global financial architecture has been finalized behind closed doors in Basel, Switzerland. The Bank for International Settlements, BIS, the central bank for central banks, has officially moved into the final implementation phase of the Basel III Endgame regulations. This is no longer a matter of debate or speculative rumor. It is a regulatory mandate that takes full effect when global markets open this Monday. The significance of this transition cannot be overstated. For more than 4 decades, the international banking system has operated under a paradigm where paper contracts, promises of gold and silver, were treated as equivalent to the physical metals themselves. This allowed major bullion banks to maintain massive leverage, effectively suppressing prices through unallocated accounts. As of Monday, that era of paper alchemy is being systematically dismantled. The implementation of the Net Stable Funding Ratio (NSFR) marks a Nixon moment for the 21st century. In 1971, the world moved away from metallic backing toward a pure fiat system. In 2026, through these new banking regulations, the system is being forced back toward tangible assets. This isn't happening because the banks want it. It is happening because the regulators have recognized that the current level of derivative leverage is an existential threat to global financial stability. Today, we will analyze the technical mechanics of this shift, the sudden liquidity vacuum in the precious metals markets, and why this regulatory reset is forcing the largest financial institutions in the world to abandon their short positions and secure physical inventory at any cost. The core of this transition lies in the reclassification of assets on bank balance sheets. To understand why Monday represents such a critical deadline, we must look at 2 specific components of the Basel III framework: Tier 1 asset classification and the Net Stable Funding Ratio (NSFR). The reclassification of gold and silver. Previously, gold was often treated as a Tier 3 asset, similar to a volatile stock. This meant that banks had to apply a significant haircut to its value when calculating their required capital reserves. Under the new mandate, gold is being elevated to a Tier 1 asset. This puts physical gold on the same level as cash and sovereign treasuries. It is now classified as a risk-free asset. This change provides a massive incentive for banks to hold physical metal to strengthen their balance sheets. The Net Stable Funding Ratio (NSFR) and the paper loophole. The most disruptive element of this rule change is the NSFR. This ratio requires banks to maintain a reliable profile of stable funding against their assets. For decades, the London Bullion Market Association (LBMA) and major U.S. banks used a loophole that allowed unallocated gold and silver, essentially paper claims, to be counted as high-quality assets. Starting Monday, the NSFR treats unallocated paper metal as a liability rather than an asset. Holding these paper contracts now carries an 85% stable funding requirement. In simple terms, it has become prohibitively expensive for a bank to hold a position in silver or gold that is not physically present in their vaults. The rules now penalize banks for holding naked short positions, bets that the price will fall without having the physical metal to back them up. The Monday deadline. This regulatory reset has forced a scramble in the overnight and interbank markets. Banks that have relied on fractional reserve bullion banking are now required to either purchase physical metal to back their positions or exit the paper market entirely by closing their short contracts. This is not driven by market sentiment or a sudden change in investor appetite. It is a matter of regulatory compliance. The banks are being forced to choose between physical acquisition or bankruptcy under the new capital standards. The liquidity vacuum and the end of price suppression. In the week leading up to this deadline, we observed a phenomenon described by many as a liquidity vacuum. Market makers, the institutions that usually provide the ask and bid prices, withdrew their sell orders. This wasn't a technical glitch. These institutions were recalibrating their algorithms to account for the fact that selling paper silver is no longer a viable business model under Basel III. For 40 years, institutions like JP Morgan and Citi could hold massive short positions to suppress prices because the cost of doing so was negligible. Now, the cost of carry has skyrocketed. When banks shift from being the primary sellers of paper to the primary buyers of physical, the price floor of the asset rises permanently. We are witnessing the end of fractional reserve gold and silver trading. The industrial conflict. The race for physical supply. This rule change creates a direct conflict between the banking sector and the industrial sector. Companies such as Tesla, Samsung, and Apple require silver for the production of electric vehicles, semiconductors, and solar panels. Historically, these companies benefited from the low prices maintained by the bank's paper manipulation. However, as banks are now forced to hoard physical silver to meet their Tier 1 capital requirements, the available inventory for industrial use is shrinking. We are seeing early signs of panic buying in the industrial sector. Manufacturers are attempting to lock in supplies before the banking sector absorbs the remaining global inventory. There is simply not enough physical silver produced annually to satisfy both the industrial demand of the Green Revolution and the new capital requirements of the global banking system. C. The geopolitical pivot. The Eastern model wins. It is significant that China and the Shanghai Gold Exchange have been compliant with these physical-only standards for months. The East has long emphasized the accumulation of physical metal over Western paper derivatives. By passing Basel III, Western regulators are effectively admitting that the Western model of paper alchemy has failed. This is a strategic concession. The West is aligning its banking regulations with the East, acknowledging that in a period of high debt and currency instability, physical metal is the only true safety. This transition levels the playing field for countries like Russia and China, which hold massive physical reserves, while placing the debt-heavy Western nations at a significant disadvantage. D. The devaluation of the dollar and the rise of stagflation. The revaluation of gold and silver as Tier 1 assets has a direct negative impact on the US dollar. To purchase the physical metal required for compliance, banks must sell other assets, primarily US dollars and treasuries. This creates downward pressure on the dollar at the same time that gold and silver are being revalued higher. Furthermore, as banks are forced to hold more capital, they will naturally lend less. This will trigger a credit crunch in the general economy, making it harder for businesses and individuals to obtain loans. This deflationary pressure on economic growth, combined with the inflationary pressure of currency devaluation, leads directly to a stagflationary environment. In such a scenario, silver has historically been the top-performing asset class, as it serves both as an industrial necessity and a monetary hedge. E. The exposure of fraud. The coming audits. With the implementation of Basel III, we expect a new wave of stringent audits. Regulators will no longer accept a bank's word that the metal exists. They will require proof of allocation. For years, there have been suspicions that banks were double-counting leased metal, counting the same gold bar on multiple balance sheets. As these audits commence this quarter, any bank that cannot prove physical possession will face severe penalties or closure. This creates a doom loop where banks must buy metal on the open market to cover their shortfalls, driving the price up against their own short positions. The implementation of Basel III Endgame this Monday is the signal that the global financial cycle has turned. The era of infinite leverage and paper manipulation is being replaced by a system of transparency and physical backing. This is a slow, bureaucratic return to a gold standard disguised as banking regulation. The institutions that have managed the global economy for the last half-century are admitting that fiat currencies are failing. They are preparing their lifeboats, and those lifeboats are made of gold and silver. This is a massive transfer of wealth. Those who hold paper assets, including unallocated metal accounts at major banks, are at risk. If you do not hold the physical metal, you are essentially holding a bank's liability at a time when that bank is being forced to deleverage. The mainstream media will likely ignore the technical details of the NSFR and Basel III, focusing instead on market volatility without explaining the root cause. But the root cause is clear. The rules of the game have changed. The system is being forced to be honest for the first time in 40 years. As the banks step back from manipulation due to these new regulatory costs, true price discovery will finally occur. The price of silver must rise to a level where physical supply meets physical demand without the interference of paper dilution. That price is significantly higher than what we see on the screen today. The banks are buying, the nations are buying. The question is, are you aligned with the new rules or are you still betting on the old ones? Follow the money, monitor the regulatory shifts, and prepare for the Basel III era.
While you were sleeping this weekend, the global silver market just suffered a massive tectonic shift. On the Western exchanges, silver is sitting at a comfortable $79.39. It looks calm, it looks stable, but that stability is a lie. Across the Pacific, in the heart of the dragon, physical silver is currently trading at over $90.25 an ounce. We aren't talking about a few cents of difference. We are talking about an $11 spread, a massive gaping hole in the fabric of global finance. In the world of professional trading, this is what we call a broken market. Behind the scenes, a silent war is being waged. On one side, the Western paper markets, the COMEX and the LBMA, are desperately trying to keep the lid on the price. On the other side, China is vacuuming up every physical ounce of silver they can get their hands on, paying massive premiums just to secure the metal. The question isn't whether silver will hit $100. The question is, why is the West pretending this isn't happening? Today, we go deep into the Asian guy AI psyops, the massive arbitrage drain, and why your paper dollar is officially entering the endgame. Let's look at the hard data. As of late December 2025, the spot price of silver in the West, the price you see on your mainstream trading apps, is hovering just under $80. But the Shanghai Gold Exchange, or SGE, and the futures numbers tell a completely different story. We are seeing $82.07, $85, and in the retail physical market in China, a staggering $90.25 per ounce. Normally, an arbitrage situation, where the price differs between two markets, might be a few cents, maybe $1 at most. Traders usually buy low in the West and sell high in the East until the prices equalize, but an $11 gap? That is a sign that the equalization mechanism is fundamentally broken. It means the West is running out of physical silver to send to the East to stop the price from soaring. Adding to the chaos is the Asian guy phenomenon. In the last few months, a network of over 36 different YouTube channels, all using highly sophisticated AI avatars, has flooded the internet with silver news. Some call it a psyop, a psychological operation. Is it a disinformation campaign designed to trigger FOMO? Or is it a distraction to keep retail investors confused while the real whales move 15-kilogram silver slabs across borders? Whether the AI channels are real or fake, the $90.25 price tag is verified by real people on the ground. This isn't a theory, it's a transaction.
To understand why silver is hitting $90 in China, you have to stop looking at it as just a shiny coin. You have to see it as a strategic industrial weapon. The industrial vacuum. China has cornered the market on the green revolution. They produce nearly 80% of the world's solar panels and a massive portion of the world's EV batteries. Silver is the best conductor of electricity on the planet. It is not optional for these technologies. It is a vital necessity. While the West treats silver as a speculative commodity to be traded for paper profit, China treats it as raw fuel for their industrial empire. The $11 premium they are paying isn't expensive, it's a security premium. They would rather pay $90 now than have their billion-dollar factories go dark because they couldn't find metal at $80. The paper versus physical deathmatch. For decades, the price of silver has been suppressed by paper silver. For every 1 ounce of real, physical silver in a vault, there are hundreds of paper ounces traded on the COMEX. This allows big banks to manipulate the price by selling ghost silver they don't actually own. But China is calling the bluff. By demanding physical delivery and paying $90, they are forcing the paper dragon of the West to bleed. If you can sell silver for $90 in Shanghai, but it only costs $79 in New York, every smart trader on Earth will try to buy from New York. Eventually, the Western vaults will be empty. That is the moment the Western price teleports to $100 plus to catch up with reality. The AI psyop in information warfare. Why the 36 Asian guy AI channels? In a financial war, information is just as important as the asset. If the powers that be want to prevent a panic buy in the West, they flood the zone with trash data. They make the silver community look like conspiracy theorists. By using AI to create a boy who cried the wolf effect, they can keep the Western retail investor from buying until it's too late. While you're questioning if the YouTuber is a robot, the Chinese institutions are smiling behind their massive silver reserves. Let's talk about the elephant in the room, the US dollar. The USD is a dying currency. It is losing value by design. Every year, the Federal Reserve prints more legal tender, diluting your savings and your hard-earned labor. Most people have forgotten what money actually is, but the U.S. Constitution hasn't. Article 1, Section 10 clearly states that no state shall make anything but gold and silver a tender in payment of debts. We are moving back to a world where real wealth is defined by what you can hold in your hand, not what a bank says you have on a screen. The $90 price in China is the price discovery of a collapsing fiat system. It is the market's way of saying the dollar is worth less than you think, and silver is worth more than we're allowed to tell you. In the silver market, we don't just talk about diamond hands, we talk about the diamond fist. Holding silver isn't just a trade, it's a statement of sovereignty. It's a way to keep your wealth outside of a system that is currently cannibalizing its own citizens through inflation. So, what is the endgame? The markets are currently digesting this $90 price point. As the global saturation of these prices continues, the pressure on Western exchanges becomes unbearable. We have entered the volatility phase. Expect wild swings. Expect more AI-generated noise. Expect experts on mainstream media to tell you that silver is a bad investment, even as it climbs toward triple digits. The takeaway is simple. The East has recognized the true value of silver. The West is still playing with paper. History shows us that physical reality always wins over paper illusions. The gap between $79 and $90 is not just an arbitrage opportunity, it's a final warning shot. The spring is coiled. The smart money has already moved. The only question left for you is, are you holding the metal or are you holding the promise? What do you think? Is the $90 silver price in China a sign of an imminent global financial reset, or is it just a temporary market glitch? Let us know in the comments. And remember, in a world of paper, be the metal. Happy New Year, ladies and gentlemen. Welcome to 2026. While the world was busy popping champagne and counting down the seconds to midnight, the global financial system suffered a near-fatal heart attack. You won't see this on the front page of the Wall Street Journal, not yet, but the smell of smoke is undeniable. Here is the reality they are hiding from you. As of this morning, silver is trading at $71 an ounce on the paper screens in New York, but in Tokyo, real, physical silver is changing hands at $130 an ounce. That is a near 100% spread. That isn't an arbitrage opportunity, it is a crime scene. Overnight, the Federal Reserve quietly injected $75 billion into the banking system via emergency repo facilities. Why? Because a massive short squeeze is tearing the bullion banks apart, and the trigger wasn't a Reddit forum or a meme stock. The trigger came from the East. China has officially launched its silver weapon, and the supply chain for the West has been severed. The price on your screen is a lie. The panic behind closed doors is the truth. I'm your channel name, and today we are investigating the silence before the explosion. Let's follow the money to where this started, the Shanghai Port Authority. According to leaked logistics reports and confirmed translations of internal directives, at exactly 11:47 p.m. local time on December 31st, Chinese customs officials began rejecting silver export clearances. Containers destined for COMEX-approved delivery warehouses were sealed, stamped export rejected, and held pending regulatory compliance reviews. This is diplomatic speak for a full-blown embargo. But here is the detail that turns this into a thriller.
just hours before the ban went into effect. Sources indicate the United States made a desperate, back-channel attempt to secure 50 million ounces of physical silver. The proposal was frantic: immediate delivery, payment via U.S. Treasury bonds, and bypassing the SWIFT system through bilateral currency swaps. Beijing's answer was 2 words: proposal rejected. The immediate fallout was catastrophic for the paper market managers. The bullion banks, the entities that sell silver they don't own to keep the price down, suddenly found themselves in a delivery vacuum. They are short millions of ounces, and the only place to get the metal just locked its doors. This explains the $75 billion emergency liquidity tap at the Fed. That money wasn't for operational maintenance, it was margin call money. It was bailout money to prevent a systemic collapse of the clearinghouses that hold these toxic short positions. And how did the U.S. regulators respond? Did they let the free market discover the true price? Of course not. The COMEX dropped a margin nuke. On New Year's Eve, they raised margin requirements on silver futures by 30%. This is the 3rd hike in December alone. For the uninitiated, when an exchange raises margins, they are forcing traders to put up more cash to hold their positions. If you can't pay, the computer automatically sells your position. This creates artificial selling pressure. It is a desperate, rigged mechanism designed to smash the price down on the charts, while in reality, the vaults are empty.
Now, let's peel back the layers. Why is this happening now? This is not just about trading profits. This is a kinetic financial war. We are witnessing the great bifurcation of the global monetary system. First, look at the paper versus physical divorce. For decades, the price of silver was determined in London and New York by trading paper contracts. If the price got too high, banks would print more paper contracts to flood the market and drive the price down. It worked until the metal ran out. Look at the numbers. In Korea, silver is $97. In Kuwait, silver is $106. In Japan, silver is $130. The East is trading the asset. The West is trading the debt. When the price of a commodity is nearly double in the physical market compared to the futures market is effectively broken. It is no longer a price discovery mechanism. It is a suppression mechanism. The $71 price on your screen is a ghost price. Try to buy 1,000 ounces at that price for physical delivery today. You can't. Second, consider the geopolitical stranglehold. China controls roughly 60 to 70% of global refined silver processing. By restricting exports, they are not just squeezing a few hedge funds, they're squeezing the U.S. military-industrial complex and the green energy sector. You cannot build Tomahawk missiles, solar panels, or EVs without silver. By cutting off the supply, China is forcing the U.S. to burn through its strategic reserves, if any even exist, or print money to buy metal at exorbitant rates on the black market. This is resource nationalism weaponized to destroy the purchasing power of the dollar. Third, notice the domestic crackdown. Washington State, historically a hub for privacy-minded bullion investors, just reinstated a tax on precious metals after a 40-year exemption. Why now? Because the government knows the exit doors are closing. They are erecting financial Berlin walls. They want to make it expensive and difficult for you to exit the fiat currency system. When a government starts taxing the lifeboat, you know the ship is sinking. Finally, the bailout of the shorts. The $75 billion repo injection is the smoking gun. It confirms that the banks are net short and trapped. If the price of silver were allowed to rise to the Japanese level of $130 in New York, the losses for these banks wouldn't be in the billions, they would be in the trillions. It would wipe out the equity of major Wall Street institutions. The Fed isn't fighting inflation anymore, they're fighting the insolvency of the bullion banks. So what happens next? We are in the eye of the storm. The COMEX margin hikes are a delay tactic, a desperate attempt to kick the can down the road one last time. They hope that by crashing the paper price, they can scare you, the retail holder, into selling your physical metal back to them. Do not fall for it. The The disparity between $71 and $130 cannot exist forever. Nature abhors a vacuum, and markets abhor a price gap. Eventually, the paper market will break. The exchanges will declare force majeure, meaning they will settle your contracts in cash because they have no silver to give you. When that happens, the price doesn't just double, it goes vertical. We are looking at a repricing of reality. The verdict is clear. The year 2026 will not be about investing, it will be about possession. If you can't touch it, you don't own it. If it's in a vault in London that you've never seen, it's not yours. If it's a paper contract, it's a promise from a bankrupt entity. China has made its move. The Fed has printed its response. The war is no longer cold, it is red hot, and the battlefield is the silver market. Watch the premiums, watch the repo market, and most importantly, watch out for the moment the COMEX simply stops trading. I want to hear from you in the comments. Are you seeing physical silver shortages at your local dealers? Or do you think the Fed can print their way out of a resource shortage? Subscribe and hit the bell, because in a market moving this fast, yesterday's news is today's bankruptcy.